Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Simeone. She's the Managing Director at HarbourVest to discuss the private credit market and why it has become a primary financing mechanism for private equity. Karen, it is great to have you with us. Welcome to Trade Talks.
Thank you so much, Jill. It's great to be here.
You got it. And can you provide us with a brief overview of where private credit came from and what has fueled its growth and the current state of this market?
Sure, absolutely. I mean, I think that many people feel that private credit is a more recent phenomenon, but if you actually look back at private credit really started in the early 2000s, and it's evolved from being the lender of last resort to the lender of choice. Back in the early days, in the early 2000s, we often saw that borrowers who weren't able to get financing from banks or other sources started to tap into the nascent private credit market. As we evolved through the GFC and then later had bank regulation following that, we saw an increased use and reliance on private credit. And today, what has happened is really the asset class has evolved into the financing partner of choice for private equity and really increasingly serves larger borrowers, healthier borrowers. So it's really, kind of turned on its head over this time.
The market is currently paying a lot of attention to private credit, with many investors upping their exposure to the asset class. Why is that? And is now the right time to get in, or has that trade already played out?
Yeah, no, it's absolutely a good time to be in private credit. Again, this asset class has been doing nothing but really gaining momentum. If you look at sort of the long-term trends here, I think investors have seen that. They're looking for more private credit in their portfolios. And I also think that private equity firms, who are the largest users of private credit, have really decided that this is the right asset class for them to use for their portfolio companies. And we could get into why that is.
Yeah, and I wanted to get into that with you. Primary financing, private credit really has become the mechanism for private equity. Break that down for the audience a bit. Can you explain the reasons behind that trend?
Yeah, absolutely. I mean, when a private equity firm is buying a company or even refinancing a company, they need to make a decision, sort of, how do I want to finance this business? And they have choices depending on whether the public markets are open. I think private credit provides speed and certainty, first and foremost, because the market is pretty much always open, with a few exceptions here and there. And when a private credit provider offers to do a deal, a private equity firm knows they're going to close on those terms versus having flex, for example, in the pricing. As well, there's higher confidentiality when going with private lenders, and more flexibility in these capital structures. So a lot of conversations going on about the cost of private credit right now. And yes, it is more expensive for these private equity firms to be choosing private credit, but it's really not relative to the public markets. It's actually pretty good, and there's all these other benefits.
How are borrowers faring in this higher interest rate environment? Do you expect to see an increase in defaults as portfolio companies grapple with higher borrowing costs?
Yeah, so we think that portfolios across the private equity industry look pretty good. We think that, many private equity managers have done an excellent job managing their portfolios for liquidity, for cash flow within their borrowers. And as a result, we do not expect a huge uptick in defaults, at least in the corporate space. We think that companies have really focused on the blocking and tackling associated with making sure they have the cash they need to fund their operations. So undoubtedly, the math has changed for borrowers that may have procured private credit deals, in the 2019 to 2021, even 2022 early days period. Interest rates, base rates have increased by 5% over that period of time. But these companies have actually reacted pretty well. And it's for that reason that we're really not seeing a huge uptick on the horizon.
So Karen, what is HarbourVest's approach to private credit? Can you provide some insights into your team's strategies and approaches?
Yeah, I mean, look, we are, I think, known as a private equity firm that invests in primary capital, meaning into other private equity firms, into private equity secondaries, into direct equity co-invests, infrastructure, and directly into credit. And so our approach to sourcing deal flow, which we think is really the most critical thing, is to take a very multifaceted approach to relationship management with the private equity firms. Again, the private equity firms are the ones who are deciding which lender do I want to use? Do I want to choose private credit or the public markets? And they're deciding which lenders are going to be in my deal. And it typically is a club of lenders. And so we take the approach that, given the multifaceted relationships we have with these private equity managers, that we're able to, discern and gain allocation to what we believe is the highest quality deal flow.
And finally, how do you see the private credit market evolving in the coming years, and what opportunities or challenges should investors be prepared for?
I'd go back to that sourcing comment that I just made. We really think that it's very important as the asset grows, as a manager, to be able to gain access to the highest quality deals. I think from an economic perspective, many transactions look fairly the same. We know that base rates today, have increased by 500 basis points. And we're approaching 5.5%. We know that spreads have ranged, plus or minus 600 basis points. So you're seeing an 11.5% yield before you even get to fees. And yet the question is, okay, which 11.5% yield do you want in your portfolio? Which are the highest quality companies? And so I think, as the asset class evolves, the dispersion of returns potentially among managers as they're choosing deals and gaining access to deals will continue to evolve as well. And I think that, that's a positive for the asset class. I think it's maturity for the asset class. I think the other trend is that we've increasingly seen larger and more high quality businesses tapping the private credit market rather than going to the broadly syndicated loan market or the high yield market. And I think that's a trend that's going to continue. I think we're going to see bigger deals. And I think that's because of all the benefits of this asset class.
All right, Karen, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks so much, Jill.